This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 183. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. The initial speakers and sponsors are now live. We just announced the initial speakers and sponsors list for our next virtual conference, the SNN Network Summer Virtual Event, which will be held on August 17 through 19, 2021. Amazing list of speakers. I'm so excited to have you all hear them. We got Guy Spear. We have today's guest on the pod, Mark Jones, Perth Toll, Caitlin Cook, Julia Karen. I mean, the list goes on. We're so excited. And so when you go on the website, go and see that initial list right now. Our website is conference.snn.network. Registration is open, so go click and register. Click on the button to register once you're there. We'll actually be announcing the initial presenting companies next week. So register, get all the updates as they come live. And that website for our conference is conference.snn.network. The SNN Network Summer Virtual Event coming up August 17th through 19th, 2021. I'll see you all there. Now, for this episode of the Planet MicroCap Podcast, as I just said, one of our keynote speakers for our upcoming event, Mark Jones, he's today's guest on the podcast. He is the fund manager at Pragmatic Capital Management. And I recently came across Mark's interview with SumZero, and somehow I missed his fantastic interview on Toby's Acquirers podcast that he did back in March 2019. I listened to both and thought that this person needs to be on more shows to share his insights, and I thought we'd start here. I mean, he was talking about GameStop and AMC before it was in vogue, a true contrarian to the core, and I'm so excited to share our conversation today. And as I said, he'll be a keynote at our upcoming SNN Network Summer Virtual Event 2021. Go register, conference.snn.network, so that you can hear what he has to say there. So thank you again for tuning into episode 183 of the Planet MicroCap Podcast, and please enjoy my conversation with Mark Jones. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And I'm really excited to introduce to you our guest today. We were connected on LinkedIn a while ago, and you know how sometimes you connect with people on LinkedIn, and you're like, all right, I don't know how we found each other, but we did. And then right? And then I saw that Mark is part of the SumZero. I think you're still part of it. Right. I saw a post there, and then I did some research. And I don't know how I missed this, but you did an epic interview with Tobias Carlisle on his podcast back in March 2019. And so had to invite him on. You guessed it. My guest today is Mark Jones. He's the fund manager at Pragmatic Capital Management. Mark, thank you for joining me today, man. How you doing?
Yeah. It's so great to be here. You know, I've been, following you for a while now, just watching what you've been doing. And I knew that eventually, our paths would, intersect, but I'm a huge believer in organic connections, right? And I think that, the timing was just right. The stars aligned. I just did a great podcast with SumZero, and I also did a great podcast with, Tobias a couple of years ago that still, is living and breathing. if you will, with some of the names that are in there. And I'm really happy about that.
Oh, yeah.
But I'm really happy to be here, to, just have a great conversation with you, share ideas about how we think about things. And I think there's going to be a lot of overlap. And I'm really just looking forward to having a conversation that has a lot of novel kind of concepts, ways of thinking about the market, but that makes sense, because that's all I've been thinking about for almost 7-8 years now, of just thinking about the market differently in one shape or form. If it's the hedge fund I have now, the first fund, research business, B school, it's just my mind is always on thinking differently about the market. So I'm really excited about this conversation.
Awesome. Look, no pressure, okay, to have novel ideas. Look, because they ain't gonna come from me. This is all gonna be from you. So no pressure. All right. But you listen to this, so like I always love, especially with the first conversation. I love to know your background. Where did your passion for investing begin?
Yeah. So for me, I would really say that it actually started as a passion for business. And it ultimately, kind of evolved into a passion for investing. As early as I can remember, like literally my earliest memories, in life were questions about business. What is business? What are these buildings with people in there with, the same type of clothes on, selling things? What is money? These are just like questions that I intrinsically had. I literally made my earliest memories. And, over time, I just got to a point where the people around me couldn't really answer those questions. And I just went on this quest, if you will. And I ended up studying accounting, undergrad and grad. I'm from Pittsburgh, so I went to the University of Pittsburgh, CPA, all of that, recovering CPA now. And I ultimately knew I wanted to get over into investing because that seemed like a great place for people who love business, because you can actually utilize this knowledge that you're naturally going to acquire about businesses. And that was really like the foundation. Then I ultimately went to Carnegie Mellon, and that took it to another level of where I found that I really got the tools to really, deconstruct a business, combined with my natural way of thinking. And it's just, really evolved from there, where now my passion is just markets and how the market itself is a business, and, buyers and sellers, supply, demand. It's just this never ending quest to learn more about business and investing. And so, so what I'll say is it's been there my entire life, but it's just taken different shapes as time has gone on up to today with, Pragmatic Capital Management.
Can you pinpoint like that first experience or like business, because you mentioned that you said it wasn't so much around you. So it's almost like, as you hear on when you did your interview with Toby, and we're going to get into today, you're a contrarian, like you are the contrarian, Right. So was it because like you didn't see business around you, like, oh, I'm going to do business, and like that was the first thoughts of like, oh, maybe this is how I kind of think, and I'm going to apply that eventually as I learn and grow.
Yeah, interestingly, I'll say that while there were not people around me who could answer my questions, I found that business was all around me. It just didn't talk to me. It was just, you could kind of see the evidence of it. And I think that I actually have grown to, believe that business is the monetization of life. And so, I think that's where my passion for business came from, is that this like commerce, this commercial activity, there's so much meaning involved there, across the gamut. So I would say that my earliest memory, honestly, was just something as just like a kid, something as simple as a convenience store, just a store that's in this shack of a building, and you go in there and there's just all these products and prices and labels on everything. And, I always remember, seeing that, chips were 25 cents a bag. And I just remember asking every adult that I was with, why are they 25 cents? And, you get these looks like, what do you mean? Like, it's 25 cents, right? It's the price.
That's what it costs, 25 cents. Yeah.
Right. And I'm like, well, why not 24? Why not 23? Why not 26? Right. And, this is a decision. I guess now I'm older. I know what I was trying to do. I looked at this as these were decisions that the store owner made to put a price on everything in here. There's nothing in here that doesn't have a price. And there are very few things that have the same exact price. And I was just curious about how those decisions came about. And so that's my earliest memory of this thing of business, or even another one. This is a good one. I always remember going downtown with my mom, and I'm young, very young, and I just remember being downtown Pittsburgh and seeing like these big buildings. To me, I'm a kid, right? And I see all these adults, and they all have these clothes on, these suits, and they're all so just going somewhere, and they're going into these buildings. And I just always wondered, what's in those buildings? I learned eventually, but what is this that has summoned all these people from their beds this morning to descend upon downtown? At the age of 4, 5, 6, these are kind of the questions that I had. So those are my earliest memories, and honestly, it's been a love affair ever since. It's gone on twists and turns and different things like that, but that's the beginning, and I never wanted to do anything else.
You said a couple of things that were really profound, to be honest, that I'd never heard before, and you put it so eloquently. Like the idea of like business was all around me, but it didn't talk to me. And this idea of business is the monetization of life. Like I'm probably going to name this pod that or something to that effect. Like that was really good. I mean, that's such an interesting thought, that business is all around you, but it doesn't talk to you. I don't know. I want to kind of like deconstruct that a little bit, because that's really interesting to me, because it really is. I feel that same thing. And it's not like, and like you can have people talk to you about business, but I know what you're saying in that, like, it's in everything, in the cards that are on my desk, and this post, this, that, the other thing, but it's not physically talking to you. I don't know. Right. It's just it's a fascinating concept.
Yeah. So I'm kind of like a part-time philosopher, right? So I also think about the world in this kind of principled way as well. And I think that we're actually all philosophers, in that we all have, ways of viewing things. But, some are more aware that they have a philosophy than others. And I think the more aware you are that you're trying to, and I don't want to get too esoteric here. But
no, go. It's fine. Go.
Okay. You're trying to perceive reality as close to perfect accuracy as possible. I believe that most things in this universe are not obvious. It's not necessarily physical. And an example is kind of like a relationship. Let's say if someone were to, see you out and you're with your spouse, that person can likely tell you all have a relationship, but that relationship is not physical. The relationship that people are capturing is something that's invisible, but you can experience it, right? So I think that kind of like capturing the essence of phenomena, if you will, that's how I go through life, and it just happened naturally. I would just make observations or feel things. And with business, it's just, business is a distinctly human act. You don't observe any other species engaging in business. You may possibly see a dog possibly drop a bone next to another dog, and the other dog gives that dog something, but I doubt that ever happens with any type of regularity. It may be, a trick that's taught, but this act of exchanging something of value is a distinctly human act. And I'm fascinated by it. And yes, it's all around us, everything. If you live in a developed society where, you're not, completely self-sufficient, business is everywhere. I'm in a co-working space. Everything that I have, I purchased, right? I don't see anything around me that I made myself. And the things that I do make, kind of like, investment ideas, that's commercialized. And I monetize that through, through the business, through Pragmatic Capital. So it's all around us. And it's just fascinating to see in our lifetimes, the proliferation of like the internet, and just see businesses come into existence and become, $100 billion market cap companies. It's doing something that didn't even exist in 1995 or 2000. And you can just see how these businesses have actually changed life, how people live life. So it can kind of be like circular. Business affects life, life affects business. And so that's why I believe that business is the monetization of life, because in order to participate in a lot of life, there's a price tag associated with that, kind of like an amusement park.
Even if you're off the grid, it's like, it's not like when, you know, even if you're going to choose or that's where you are in life, like you have to transact if your goal is to survive, you know, I mean, right? Like you need, you're going to have to, if you're going to be on another place, even without, especially if there's going to be other humans, but if there's going to be no humans, like you have to make some sort of transaction in order to keep going. Right. Like, I mean,
right. And I would say to even get off the grid, you're going to have to pay for that. You're going to have to take a plane. You're going to have to even be right. I want to, you know, to get off the grid, you have to fly somewhere that's remote. Well, you have to pay for that ticket, right? The clothes that you're going to go, everything you pack in that bag to go off the grid, you know, it's like you can't. It's really difficult to take business away from life as we know it. Maybe in some remote areas in like the Amazon, you know, there's not business in a sense where it's like monetized, but there's definitely going to be a barter system, right? You're going to exchange things. That's like, so, and we do these things in order to realize some desires that we have. We don't just exchange things for nothing, even if it's just for fun. You desire fun, you know, there's always some desire on the other end of it. So I'm just fascinated with it, and it actually shapes how I see the market, how I see, you know, businesses. This isn't just kind of like, you know, some philosophical view. It helps me so much when I need to conceptually understand, well, what is Pinterest or Trade Desk or Peloton in essence outside of the market? What is this business, which is essentially a bunch of people that have come together to, you know, provide some good or service to people who have a demand for that good or service?
Yeah, dude, there's so many rabbit holes we can go down. I'm gonna take us back for a second, and then we'll go back to some of those rabbit holes. But you know, to catch us up, you know, okay, so graduate from Carnegie Mellon. So what led you then to your founding of Pragmatic Capital? You know, did you do something in between, or did you go right to starting your own shop?
Yeah, it was kind of, you know, I guess I was kind of like an entrepreneur by force, if you will. So I finished business school in 2016. You know, in 2015, you know, I went into business school because I wanted to join a hedge fund afterwards, because I found that that's the type of investing that I believed had the greatest distillation of just core personality attributes that I have, core, you know, just the passions I have for business. You know, I'm interested in VC, I'm interested in PE, but you know, this public equity market, you know, that to me was the holy grail for me. So went into the program to join a hedge fund. And while I was in the program, you know, I'm in school, but I'm also working on stock pitches. At any given time, there's always a stock that I'm looking at, because I was told that in order to, you know, join a hedge fund, you had to be able to pull your own weight. You had to come and have your own names and things like that. So I was basically preparing for this. And, you know, I didn't realize that along the way, I was starting to develop my own way of looking at things. And that happened because I would ask a lot of questions. I have a lot of questions. And I would ask, you know, the second years in my program, and I also developed a network of people who were in the hedge fund industry in New York and in San Fran, to kind of like review my stock pitches on a monthly basis. And I was able to learn a lot from the questions they asked me, and I also asked them a lot of questions. And I just wanted to know, hey, you know, these stocks move daily, and they move, you know, a certain, you know, magnitude over a year, 2, 3. Why is that? And I really didn't get any good answers. I'll be honest with you. Yeah, right. It's like just the simple, hey, mechanically, why is this happening? because I wanted to learn about it, right? I wanted to learn. I wanted to just be a student. I didn't want to be the best stock picker at that point. Eventually, I had grand views on, what I wanted to be in the industry, but that was many, many years in the future, a decade in the future. But I started to kind of doubt the intellectual honesty of the industry.
Interesting. Okay.
What work was actually being done? What's really going on here? Because I had questions, and there were I got a lot of responses from people across, the gamut, and they just didn't add up. And I can tell when someone's being a little too qualitative with me, where there's not as much substance to it. And ultimately, what it boils down to is, well, that's the way we do it because that's the way it's been done. That's it. So I'm this type of investor, and this is what we do. We have our operating manual, and that's just what we do. Or I'm this type of investor. We have our operating manual. This is what we do. It's pretty homogenous. There is no room for unique thought. And that's, if that's the case, I can't be in that type of environment. I wouldn't do well there. And so I said, okay, I'm at Carnegie Mellon. I'm learning about data analysis and things like that. I'm learning about regressions. Why don't I just, try to see if I can, do a big quant analysis to see of these stocks that do really, really well and these ones that do really, really poorly. Is there some type of pattern I can identify? And, if you've heard the podcast before, about this research study that I did. So I'll just summarize. What I found was there was a pattern. And what that pattern, it's not that every stock in the top 5 percentile or the bottom 5 percentile exhibited this pattern, but they took up the largest proportion of winners and losers. And what this pattern was basically ultimately a contrarian approach where, if a stock was down 60, 70%, and they went into an earnings call and they beat it and the outlook looked good, there was a really high probability that stock would do much better than the market over the following year, and vice versa on the short side. Once I discovered this, it changed my life. It changed the course of my life. I liken it to someone who's a computer scientist and they kind of stumble across an algorithm that actually works, right? And then so you just devote yourself to just fine tuning it, and you just can't walk away. So at that point, a year later, and I had the fortunate opportunity to meet David Tepper, had a great conversation with him. I actually pitched a short on GameStop when I had interviewed for an internship with this firm. And it was just a phenomenal experience where everyone else from my program said it was the most difficult interview they ever had when they interviewed at Appaloosa, but it was the most engaging set of conversations that I had. And that kind of showed me I think differently. And so in between, engaging with Tepper and getting some good feedback about my approach, looking at the data and just seeing that, hey, if you can pick good contrarian stocks, you'll do really well. And looking at the network that I had developed of people who were in the industry, hedge funds, mutual funds, and kind of seeing that, there's a lot of dogma that's driving this space. And that would be my competition. If I were to strike out on my own, I had the confidence to go ahead and, give it a shot. So after I finished business school, I launched kind of a beta fund using, the network that I developed in the Pittsburgh region. So that was Pragmatic, 1.0, if you will, and that was in 2016. So, just really quickly, I also started a research business where I started to sell the research to some of these hedge funds that I connected with, long form research, contrarian names. And now ultimately at a certain point decided to put the hedge fund in hibernation mode and focus on the research business to get my name out there more, to get the process more formalized. And then I launched Pragmatic Capital 2.0, if you will, the one I'm managing now in 2019. And, the rest has been history. We've returned over or just under 150% as of yesterday since inception, May of 2019. That's through a global pandemic. And that's with the perfectly hedged strategy, which is expensive. So, yeah, and being contrarian.
Yeah. Well, firstly, congratulations on those numbers. That's amazing. I mean, especially through this time. Like, listen, it takes a lot of gumption to be a contrarian, right? I mean, we've talked about it ad nauseum on this show. You brought it up on Toby's show. So, I mean, now we're going to get into some more nitty gritty, that investing philosophy. As you said, you describe yourself as a contrarian. What does contrarian investing mean to you, and how do you apply that to your investing philosophy?
Yeah, so I believe that the only way to generate outsized returns is to be contrarian. I believe that there are several ways to be contrarian. You can be contrarian in that you believe this company is going to change life as we know it, or an industry as we know it, and that's a longer term contrarian view, where the market may be, positive on that stock, on that company, but not as positive as you. You're a true believer, and you think this is going to 10x over 5 years. I would say that that's contrarian, but I'm not like that. I'm more contrarian in the sense of right now, there's a stock that's down 60-70%. And if everything checks out, I'm going to go long. Or a stock is up 2, 3, 4, 500%. And again, if everything checks out, I'm going to go short. So the market kind of has this momentum in one direction. Either it's going really well or really horribly. And those are the situations that I don't even come across stocks that aren't in that scenario, because my screen doesn't even capture stocks that, are doing well. And there's no indicator that, this may be a short. And definitely stocks that are doing well, I'm not going to go long. So, I'm always starting at that point. I'm allowing the market to tell me what its expectations of the future are. And so I use the price. I infer expectations from price movement. So, yeah.
All right. So, okay, perfect. All right. Because it obviously was going to be way more nuanced. Like, yeah, I buy stocks that are down 67% from their all-time highs, and I short stocks that are, at their 52-week highs, right? Like, it's obviously much more nuanced. So what are those checks? You mentioned those. So what are those checks that you look for when you see a stock that's down 67%, or when you see a stock trading at 52-week high? What are those things that you look for where you're like, okay, now it's time to initiate a position, both either long or short?
Yeah. So the other side of that is I am a huge proponent of quantified research. I'm a huge proponent of forecasting. And based on the quant analysis that I did, 6 years ago at this point, earnings calls are major catalysts. So, which I don't find that many investors actually forecast earnings, as far as the next quarter and the following year. These 5-year forecasts, that's a different type of forecast. We're talking about actual forecasts that if I know that if I'm not more accurate than Wall Street, I'm going to take a L, and I don't want to take an L. So I'm really putting my feet to the fire here. So with that, in order to do that, that means that one, this company has to actually have a positive economic outlook. So that's something where if the stock is down 60-70%, it has to be a situation where the stock and the company have kind of dislocated, if you will. And I think that to a certain degree, there's always a dislocation. I believe that the stock is the monetization of the company, but that process of monetizing the company, I have a whole theory on how I believe the market actually behaves. I believe it's based on something that I call desire to participate, more than some intrinsic value that, people talk about. And I can speak more about my views on intrinsic value. But what I want to make sure is this a great company that's just getting a hard time in the market? So ultimately, what I find is that, so I have a 4-step process, and ultimately at the end of it, the ones that make it through that 4-step process, plenty are killed. And it's not because the market was necessarily right. It's just that I don't see evidence that the market is going to be forced to correct its point of view. What I find is that the companies that I invest in almost always are in growing industries. So, you have this tide that is going well for the companies that are in that industry. I really don't want to be in a company that's in an industry that's like stagnant or in this kind of decay. And this company has to kind of fight against this momentum that's going the opposite of its direction, swimming upstream. I'm not interested in that. That's more difficult than a company that's in a great industry where there's a lot of economic activity and things are going well. All that company has to do is develop a strategy to capture more of that demand than their peers, to take share. So there's going to be a strong industry, a strong core business. The business has to be their strategy. I believe that business is a game of strategy. And I believe that strategy breaks down into what's usually known as the 4 P's of marketing: price, promotion, product, placement. And I believe that every business has their own unique approach to those 4. And the combination of those 4 that you go to market with are going to determine how well you do in your marketplace. So once I do that analysis of this business has a strong strategy, that is showing that it's effective through the revenues over time, through margins over time. So strong industry, strong core business, and also these businesses that we invest in typically have an additional line of business, a new product, a new market that's just going to be, kind of like icing on the cake that really, kind of cements this trifecta of pillars for the thesis point. Those are the situations that I'm in. And lastly, when I forecast financials, it has to, this company, my estimates have to show that Wall Street's estimates are off. Because you can have a great company and a great industry. For whatever reason, the stock is down. It could be because the industry, people, the market doesn't have it's risk off for tech right now, right? It could be, it could be a number of factors. It could be the company had an earnings call where their guidance for the next quarter was lower than the market expected, but the company provided great evidence that this is just a sales cycle thing. This isn't long term, some like temporary blip, or if you will. So you can have those situations, but if Wall Street's estimates, which kind of like a hurdle, and the company is like a hurdle jumper, if Wall Street's estimates are too bullish, that the catalyst won't come, and then you'll be holding a stock that you believe in, but there's no catalyst. So that's how I approach, the identifying and what the stocks that we ultimately invest in. This is what they typically look like. What the companies typically look like, and that bodes really well for how the market is going to price the stock, in the very near future.
Very good. All right. So, I'd love to hear an example of an experience where you really felt like, okay, this is the thesis that I'm going to implement my philosophy. Here we go. We're going to deploy. Do you have an example both on the side where you're like, sick, I was right, and then on the other side where you're like, okay, that was a good learning lesson. It may be something like what you talked about, where like, it met all your criteria, but it didn't have a catalyst, right?
Yeah.
Do you have any examples like that?
Yeah. So I would say on the long side, a good example that I would like to use is Funko. I found Funko in August of 2020. And I went kind of into the market looking for opportunities that were in this small to mid cap space, because that area of the market just was not participating in the recovery that I had already predicted, in the March lows. But there was this huge part of the stock market that was not participating, regardless of the industry you were in. So, everything else equal, if you see that, that over 80% of small and mid cap stocks, in August of 2020 are still in the red, and that percentage is much, much, much smaller for large and mega cap stocks, even if they're in the same industry, that shows me that the market is just not interested in the Russell 2000, if you will. So with that, I was going into the market looking for these epicenter stocks, if you will, and I wanted to find a company that was doing really well before COVID. They were impacted by COVID because they had to shut stores, whatever it may be. But, I had a fundamental view that this is going to pass. We're going to come out of this stronger than we were on the front end. And the strong businesses will survive. And if there was some economic substance to why this business was doing well before COVID, that probably didn't go away. So that, I was looking for that. And what I found was, I found Funko at about $5.50 a share. It started the year at about $17 a share or something like that. And so just, quick step back. Funko makes those little pop figurines. I'm not sure if you're familiar with them, little modern bobbleheads, if you will. And what I had found was that, so right before the market crash, Funko had an earnings call that they had actually pre-released, And if you pre-release and it's not good, your stock is the market hates surprises, right? Or hates bad surprises, loves good surprises, right? So with that, it wasn't a good surprise in that they had lowered their guidance for the next quarter, which would have been Q4. And so the stock had lost, 20, 30% in a day, because of this. And the stock was doing well, right before that point. So you had that hiccup, if you will, and I can explain what happened there later. But you had that, and then when the market crash happened, it just tanked, and then it was just flat for several months. So I said, this looks interesting. I don't know what happened as far as why this company, had such a relatively poor showing in Q4. They still grew revenues in Q4, but it wasn't at the rate that the market was expecting, based on what Wall Street was expecting. So with that, I said, okay, well, let's look and see, what happened in that instance in Q4. Is it temporary? Is it more long-term? And also, where was this business at before that? And how was the business handling COVID right now? And what I had found was that, Funko is a phenomenal company. And what they actually do is they monetize pop culture. Their little, pop figurines are really like, it's kind of like capturing nostalgia, if you will. If there's like a favorite show you had when you were a kid, there's probably a Funko Pop for it. And you may think that doesn't matter, but if you see that in the store and you see that character, if you loved Home Alone growing up and you saw Kevin in the scene where he says, "This is it, don't get scared," like you might like that. And what you find is that people who were customers of Funko, they weren't kids. The average age was about 35. And about 52% of the customers were women. So the market kind of, a lot of the narrative was that this is a toy company, maybe a fad like Beanie Babies or whatever. But what I had found was that Q4 was a slip up and that they relied too much on a product that really wasn't their bread and butter, which was Frozen 2, more of a kids type of movie. And they didn't make as much of the type of product that usually does really well. So they had that slip up in that quarter, but this was a great management team that was really invested in the business. They cared personally about winning and they knew the business intimately. This was, a one-time slip up. The company had never missed earnings estimates up to that point. They made a mistake. And so with that, I really believe that based on how they handled COVID, as far as, they continue to innovate, they continue to put products out there, how things were doing through their e-commerce channels it was going really well. But their international business, because the COVID shutdowns were much more difficult abroad than they were in the States. So, a lot of the reopening that started to happen in July, August, September in the States didn't really happen internationally. So they still had a lot of these like COVID headwinds, but this business was in great position going out of COVID to be even stronger than they were before, because they also significantly reduced their cost structure to where for every, for every 1% growth in revenue they would have, they could potentially have an extra 3 to 4% growth in profitability because of their operating leverage. These are things that the market just seems to not care about at all. But I knew fundamentally that it was because this whole space was just overlooked. And the catalyst would be as this company continued to report earnings that actually beat estimates, you would start to see this kind of regression back to the mean of where they were at. And then as the market realized, wait, this company is coming out stronger on the other side than they were before, because they have a really, really, really strong cult following. And the business, corrected the ship, if you will, as far as that issue they had in the product P for the 4 piece of marketing that I talked about. And sure enough, that's what's happened. They're at about 20, 22. They fluctuate between 20 and 25 right now.
Nice. And so you got it in like around 5, you said?
550-ish. Yeah.
Nice.
550-ish. So yeah, I mean, it's gone really well. And 2021
are you still a shareholder, by the way? Are you still a shareholder in Funko?
Oh yeah.
Okay.
All right. Oh yeah.
Gotcha.
Still a shareholder. I definitely believe that there's just so much trajectory for this company based on just the core product they have, new products that they're bringing online that were actually doing really well during COVID, that went from being 5-7% of the business to now 15% of the business. So that's something you want to see, and also going direct to consumer, whereas before they were kind of like a manufacturer where they sold through retailers. They just thousands of retailers they sold through. But Funko has a really strong following. If you go to their Twitter or their Instagram, they've got millions of followers. At Comic-Con, their stands have more people than most other brands, if you will. They've got a cult following. Some of their products go in the secondary market for $10,000, $15,000, $20,000, and you could buy them originally for $10. So there's just so much intrinsic demand for what they do because they monetize pop culture and they monetize nostalgia. So that's just a great example of identifying a stock that was really, really, really hurt materially. However, the underlying economics were very strong, and there was clear evidence of that. But they made one mistake, and then you had the pandemic that came. So they tripped in Q4, and then a tidal wave came in the market. So hence this opportunity was created. So yeah,
that's a great example, and thank you for sharing that one. I mean, yeah, like I funny enough, I hadn't heard of the company, and then as soon as you go on their website, you're like, oh, I know these figurines. Like you see them everywhere. But I gotta ask you. I mean, as a contrarian, I mean, during that March 2020, what was that experience like for you? I mean, were you a kid in the candy store? You were like, all right, I gotta stay disciplined. Disciplined. But what was that like?
Yeah. After I had accepted that this is happening. Because
we had to go through that first, right? Yeah.
Right.
We're about to be in a pandemic. Money, okay, yeah.
Right. It's like, wait, a pandemic? Like, really?
Yeah.
What is that actually? A real Spanish flu, right? It was definitely an interesting time. When it first started to happen, and then I'm watching the market daily. And I just see it's just going down materially. I mean, just horrible selling, right? Just like no support. And the market is an auction. Those prices that are realized, those are the prices that are settled in an auction. There's supply and demand, and price is the equilibrium of supply and demand. So, and what drives that supply and demand, there are several factors. It's not just the intrinsic value. And especially when you look at how rapidly things happen, I don't think people even have enough time to do calculations on whatever it may be. And then when trends form, a trend kind of is evidence that people are following each other. If something is going well and it keeps going well, you got to ask yourself, maybe the person who bought today bought because this thing is going so well up to today, right? So all of that, that's all in my mind as I see this selling and selling and selling and selling. Before we even knew COVID was here, right? And it's like, wow, you just look at that. I was hedged. I'm always hedged. So I could kind of wait it out and just, because my hedges, they kind of they explode in value like an airbag, right? So, if the stock, it has the shock, that airbag is going to deploy. Right. And it's going to go from being a really small portion of the portfolio to a big portion. So I'm really thankful for those hedges. So I did have the peace of mind from that. But even still, it was a difficult quarter. And I was sitting back, not to mention, you're an entrepreneur, you have investors, clients that, are concerned. And, so I'm pretty sure a lot of managers dealt with a lot of redemptions during that time because a lot of clients just were not interested. And just like there were a lot of investors in the market who weren't interested in staying in the market and they were going to cash. There were a lot of clients and investors and hedge funds that were not interested in staying in the market and they were pulling cash from you, right? So you have to manage, that part as well. It's kind of like, a football game where you've got a lot of activity happening in the stands and you just have to say, you know what? I can't focus on that, even though that matters. I have to keep my head in the game and just look at it based on the substance of it. And ultimately, once it got to a certain point, let's say early March, let's say March 10th-ish. That's when I said, you know what? It's time to start looking for opportunity. All the quotes came to me, the Buffett quotes, the David Tepper quotes, I when there's blood in the street, all these quotes that everyone loves to cite, right? I heard this voice say, hey, this is your time. This is it. If you really are, what you are, trying to become, this is it. and also I had a fundamental view that the US was going to come out of this stronger than ever. The world was going to come out of this stronger than ever. This wasn't going to be like the Spanish flu. We have the internet. People have two lives. They have their physical life and they have their digital life. The economy wasn't going to come to a screeching halt because there was so much of the economy that was done digitally. Also, I firmly believe that the government, even though government isn't known to, work quickly or together, when there's a time of crisis, you'd be surprised how quickly both parties come together and they get things done. So I firmly believe that they would not bicker while they were closing down, businesses as far as physical businesses and putting the economy into somewhat of a medically induced coma. They would have to kind of like still keep currency circulating in the system, if you will. And they can do that. They print the money, right? So I had that view that they wouldn't just let that happen, that the Fed also would, take interest rates to zero, do whatever they needed to do. This is triage mode. The people who make the money and make the decisions are in triage mode to save the economy. I took confidence in that. Similar to David Tepper did in 2008, when people were thinking that the banks were going to be nationalized and things like that. And David Tepper said, no, I looked at, the mandates of the Fed. I know the interest that they have. I'm going to bet that they're going to behave in their best interest. And 2009, he had a phenomenal year. So I kind of took all that into consideration, in addition to just studying COVID trends in Asia, because it was there first and things like that. And also just thinking that there would likely be economic beneficiaries of the shutdown orders and things like that. And I can get into that, into what I found. But once I just accepted that this was happening and I looked at what the market had just done as far as how much it went down, at that point, anything short of long-term damage, the market was going to start to regress back to where it's at, because the market has this inverse of gravity force. It wants to go up unless something shocks it for it to go down. But as soon as that happens, it's going to settle. People are going to absorb. They're going to stop being afraid. They're going to stop selling. And as soon as the selling stops, that's when you have more support. And then you have people who are going to be a little more optimistic, right? Because, hey, things are cheap now. And so that was my view. And that worked out really well.
Wow. I mean, what was the main trend that you're like, okay, I'm going to latch on to this when it was all going down, that you're like, okay, this is the one thing this is the one industry or sector that you're looking at like, all right, this makes the most sense. Once the shock of everything settles and you start to see those supports again, like, I think this will come back, whether it's faster or more sustainable. I'm not sure exactly what maybe you thought, but like, what was the main thing that you saw?
Yeah. Well, I definitely thought the market would have a V-shaped recovery. I definitely thought that the economy would start to rapidly come back. And it did. I mean, it started to that marginal growth has started to, come down a bit, but that wasn't the important thing at that point. At that point, people were talking about the Spanish flu and this is going to be Armageddon, right? So you just have to be better than that. But I thought about the economy outside of the stock market. I do kind of these like thought experiments, and I think about kind of like, so currency, it flows through an economy, it flows through a country. So I just kind of thought, okay, well, there are some places that the flow, kind of like a piping system, is going to be much slower, like restaurants or movie theaters, right? Movie theaters is a great one, right? It's going to be much slower.
I'll be asking you about that very soon.
Yeah. And I was in AMC at this time, so that didn't help. I was hedged, that helps. So there's not much money that's going to be flowing to that faucet, if you will. I thought about it conceptually. However, it's not that the faucet is dried up. It has not dried up. Actually, there's more. Right? You can go to the Fred database and you can see that consumers have more money during this pandemic than they had even before the pandemic, right? And you can see that expenditures were up. So I said, you know what? Okay, well, where's this money going to go? Because there's one thing that consumers really don't like doing, and that's saving their money. Even though the savings rate significantly went up, it was still, as far as when you look at that additional money that they got, they weren't just putting that in the bank, they were using it. And so I thought, okay, well, people are stuck in the house, what are they going to be doing? Well, one, e-commerce is going to go through the roof. It has to be, right? I mean, it's no brainer, right? And also the first thing that I thought of were they were just internet companies, because I thought, okay, well, these businesses exist digitally. This COVID pandemic is primarily a physical issue. It's hurting the real economy, the physical economy, but this digital economy, businesses that benefit from like web traffic is Pinterest, what would be store traffic to GNC, right? So you've got web traffic that I believe would pick up, because when people are at home, they're probably going to do more of what they already do. And I was starting to see early data that internet usage was going through the roof during COVID, which of course we can expect that. And we're talking as early as March, early March, you could see things just spiking, and people were working from home. But, at the end of the day, it's like if you were spending 2-3 hours on this platform and you worked 8 hours a day and you travel for how many hours a day, you're probably going to be spending a little bit more on there because it's just there. So I thought, okay, what industries are going to be the main beneficiaries of people being at home more and being on the internet more? And that's when I found, Pinterest and Trade Desk. And these basically are companies that benefit from increased web traffic, because they essentially monetize web traffic. And that worked out really well. Both of those, and I'm still in both of them. I've gotten over a 3x return on them. Actually, I believe in Pinterest. I think I'm at over 4x now. Nice. So yeah, it's gone really well, because these businesses are still innovating. They're still, businesses are much more resilient than I think the market was taking into consideration. These businesses don't want to die. So they get really alert, and they have adrenaline flowing, if you will. And they are eager to some are just trying to survive, which is great, depending on what business you are. Some are actually seeing, hey, there's a lot of demand for what we do now. Let's turn it up and let's capitalize on this. So while the stock market may have gone crazy, the actual real economy of businesses, there were some businesses that stepped up to the plate and they turned their strategy up. And I tried to at least find a couple of them to put into the portfolio.
Very good. All right. Well, you mentioned one stock that I have to ask about, because, hey, you were talking about being long in this name, before it was in fashion. All right. Back on Toby's show in March 2019, you were talking about how you were long AMC. So, I mean, one, are you still in? Did you go through this whole ride, or and if yes, what was that like for you mentally?
Yeah. So I did not go through this whole ride. So I closed stocks that represented companies that it would just take them longer to recover from what was happening, where they didn't have a portion of their business was e-commerce, right? So they can still live from that. Just stocks, because I just thought, okay, well, I'm all about earnings calls, right? That's my catalyst. It's like, geez, this business is going to be lucky to stay alive if they're going to have to get take out debt, other things like that. And so I think that COVID was just really an unfortunate event that happened for an AMC, if you will, or companies like that, or Six Flags, right? It's just, what can you do? That's like an act of God, as they say in the 10K, right? It's like, what can you do? So I closed that and I replaced that with a Pinterest, with a Trade Desk, because these are ones where I can actually get a major return from this now. And I just put an AMC on the watch list because I'm all about the marginal return. There's no reason for me to kind of, ride this. And I know it's going to be a rough road right now. Why don't I get out, find something else that I think is active now, and then in time, I'll keep an eye. And if it makes sense, I can, express that contrarian view through an AMC. So I was hedged when this all happened, so it didn't, hurt as much when it, took that decline. But yeah, as far as, the, Reddit movement, meme stocks and all of that, that's, I laugh at it, it's because my view of the market is that the market is an auction. The price is whatever the market says it is. And people can talk about intrinsic value and things like that, but I generally don't think that's what actually drives price movement. And I think that what drives price movement is just the equilibrium of supply and demand. So basically, if a bunch of people want this stock for whatever reason, for the Reddit traders, it may be because it's kind of being hyped up or whatever it may be. But for the traditional investors, it could be because, hey, this sector is working right now. That sector is not working right now. We're going to sell some of that. We're going to buy some of that. That's why, and that's going to make the stock go up. It's not because of some intrinsic view. So, to me, that just shows the mechanics of the market. So, and I did benefit from it because I have several stocks that have high short interest. With the big short squeeze, the macro short squeeze that happened across the market in January. I'm in iRobot, and that has a lot of short interest. And at one point in the morning when this was all first starting with GameStop and things like that, I know you want to ask about that, I'm sure. My position iRobot had went up about 50% intraday. I knew this is just the auction. That wasn't gonna, or I had it was highly unlikely. I think in terms of probabilities, right? And if some, so it's just highly unlikely going to sustain. I use options to hedge the portfolio. I also use options to lock in gains, so that way I can continue to stay in the name after it's up 100%, 200%. But I'm securing a material portion of those gains. So what I did was I locked in those gains. So it went up 50% in real time. I locked in 40 percentage points of those gains if I would give up 10 percentage points. And so, and it happened again. So I kind of take that dynamic approach. But I wasn't AMC through the ride. I'm happy for them. I'm happy for the CEO. He got a lifeline. They got a lifeline. So they did right by offering more shares so they can hopefully change the business around. It's not that the business needs to be changed, to be honest. They just need to be able to weather the storm. But now I think they have a wild card where now they've got so much capital that they can significantly change. They can add a whole new line of business on now that they think is kind of related to what they do. But that's I'm not if something happened that was extremely unlikely, to be honest, I don't want to give myself credit for that, because I want to give myself credit for the making the best decision with the information that was available.
Yeah, I mean, look, even the best prognosticator, even if you thought, you're like, all right, it's going, with AMC in particular, like, okay, things are just taking a huge hit. It's a pandemic. Obviously no one's going to a movie for who knows how long. Yeah. And we, even if you projected like it was going to open up when it has, like in the last couple months here, for it to go where it did was just, there was no way. So I mean, like,
I'll give you an interesting stat that I saw. I love this time because again, it just showed that desire to participate. It's just an extreme example that's what drives price movement on any given day of the week. So what I saw was that there were over on one particular day where the stock had went up like 50, 60%, 80. It was like, some huge number. The daily volume that day was over 1 billion shares. I think it was like 1.28 billion shares changed hands that day. The total shares that were in free float was like 200 million or something like that, 300 million. Yep. So if you just do the math, look at the revolution of that same share was bought and sold multiple times that day. But every time it has a revolution, the price is going up. Right? It's like you and I could theoretically, if I had this cup, say I'm going to sell it to you for $10. I said okay, and I say I'll buy it back from you for 15, and then we just keep playing this game. I'm not saying it was intentional, but structurally that's what happened. You have this like same people kind of is going around and around and around. So yeah, I mean, it's obviously not sustainable because it may take some time because that means that desire to participate has to remain at this level and actually increase for the stock to keep going up. And I don't see that happening. But that's not my game. I'm not in it. It's not a holding. It's fun to watch. But it's a great display of market structure. And as much as some people may want regulators to do something about it, there's nothing that can be done about it in the sense of the price is what the market wants to pay, what the next investor wants to pay for. And if there's enough, the price is the weighted average of demand. So any stock that I'm in, I'm contrarian, at least at first. And it's not that I'm the only person that has that view. I'm not. There are other shareholders. It's just that we're in the minority. The weighted average of views for this stock is more on the negative side, right? So there's always going to be both sides, but it's skewed. So I think that the price is always going to reflect whatever that skew is on the seesaw, and there's nothing that anyone can do to stop that.
Absolutely. So Mark, this is my favorite question I've been asking in the last couple of interviews, because especially a contrarian investor like you, what's your best overreaction right now to everything that you're seeing? Like it's a thought experiment. Just you have your core observations of what's happening right now, and this isn't to say that this will happen. Like, it's actually what you think will happen. But like, if you had to overreact to what's happening right now in the markets, what would that be?
So just to clarify, this would be something that I believe is going to happen. I think it's such a big deal that I would overreact to it. Is that what you mean? What am I excited about in the sense, or are you saying what do I think the market's overreacting about?
That's a good counter question. As being the open-ended question that I am, I would just say you pick. But
I would say look at this, like look at this. Do you not see this type of moment?
Yeah.
Okay. I would say the operating leverage that the retailers who survive COVID are going to have is going to blow people's minds. And what I mean is that profitability, earnings per share for many of these retailers is not just going to increase 20%, 30% this year. It's going to multiply. It's going to multiply because they learned that they can operate with much, much less overhead. COVID taught these companies that they could be much more lean than they thought. So these companies that had to reduce their staff by 25%, right? 30%, as much as they could, but they stayed in business and they kept going. So what you find is that a lot of them are not bringing employees back at the same rate that they were, because they found that, hey, who's to say that the number we had was the right number anyway? Also, employees have been working a lot harder, doing a lot more work over, COVID time. So I think that maybe a lot of the average employee mindset was, a lot of people were furloughed or let go. Like, I'm happy to still have this job. And also this team approach of we're in this together. I think that businesses became much more productive. So with that, you're going to have, and this is a situation Funko's in, or Children's Place, which is a company that I'm in, that had just one of the best earnings calls I've ever seen earlier this year. With the operating leverage is that, again, if you have a company that gets, for every 1% of revenue growth, they're able to get 2, 3, 4, 5% of EPS growth. That's going to completely change models that Wall Street has. And if these companies just keep a PE that is the same as where it's at now, with that earnings growth, it's going to be ridiculous. I think that's going to be the big story when this year ends and we're in January of 2022. That's going to be the big story of, wow, when these retailers came out of COVID and they got that first full year, it was just the performance. People are going to be blown away by the earnings per share growth of so many of these retailers, because they're so much more lean now. They're just so much more lean. But the demand hasn't changed. You still have that top line demand for what you do, but you're doing it in such a greater level of efficiency that as an investor, if you think about earnings, like that's the holy grail, right? If we EBITDA or EPS, it's going to multiply. I think that's something that the market loves, and like any name that I was ever in that multiplied. I was in RH years ago, and that I got a 3x or something like that or Weight Watchers years ago. I'm in Weight Watchers again because I found another opportunity shortly after the podcast I did with Toby, where we were talking about Weight Watchers, and he brought it up. I said, well, I'll have to look at it again. I did look at it again, and I did get in. So I'll buy and sell the same name because I really get into scenarios right? Is this, how has the scenario changed? Or is this a great contrarian scenario? So what I found with Weight Watchers, RH, the stocks that I had that multiplied, yes, revenues grew more than Wall Street was expecting. But when there's that operating leverage, it's kind of a slingshot for earnings. The market goes gangbusters over that. And I think that's going to happen in this retail space. So the Russell 2000 is going to do really well, I believe, through this year. So I think that's the thing that people still aren't appreciating. But I don't think the average market participant is really into financial modeling and actually quantifying the research, quantifying the economic substance. Hey, this is happening. A lot of people were let go, and people are still finding jobs in other places, but companies are much more efficient and much more productive and lean. What does that mean? I don't think that it's gotten to that. Hey, the light bulb goes off, lightning bolt goes off. Earnings growth is going to be ridiculous for these companies. So yeah. And that's why I'm in Funko still and Children's Place still, and I'm up, several 100% on them because there's still so much more, gains to be had from there.
That's a super interesting take. I'm definitely going to be looking into that because you would have thought that's already been priced in, but maybe it hasn't been on a few of these names, huh?
No, I don't think so. I think that what's happened is I think it's like two stage, and the same for the first batch. So the portfolio was split into two batches. You've got the tech beneficiaries, if you will, stay-at-home beneficiaries, and then you have these retail reopening plays. So the tech ones, they had their first spike because the market saw, hey, if you want a company that's actually doing well during lockdowns, this is the one you want to get in. This is the industry you want to be in. And while people have a view that, that's kind of played out and fizzled out, the second leg of that is, no, the economy has structurally changed. What happened was a massive acceleration of the digitization of the economy. There are companies that are going to be long-term beneficiaries of that. So their trajectory has changed materially. So that's like two-pronged. And that's why I'm still in Pinterest and I'm still in Trade Desk. But the retail, those stocks were beat up so bad. The first bet, if you will, was just a regression back to where they were at least at before, around that level. Because long-term, even medium-term, these businesses were not, as long as they made it through, they weren't structurally damaged. They're going to be fine. This is just like the market came back because, COVID happened, but it was handled, it was absorbed, and you keep going. So there would be a regression kind of back to where it was at before. But the second leg of the retail plays, if you will, is that, again, these companies are now structurally different coming out of COVID. And that's where I think the next leg of growth for these stocks is going to come, in that you see that, no, this isn't just, hey, this stock price regresses back to where it was at, before COVID time. This is, hey, no, this is a structurally different company post-COVID and pre-COVID. And that's where I see kind of this like orchestra playing out. So both have multiple legs. COVID had multiple legs, if you will. There's the immediate 2020 impact. And then for everyone, there's going to be a 2021 and beyond impact, So, and this is how I see it kind of manifesting into these companies.
Very good. All right. So we're rounding the bend here on our interview today. And I mean, I've been having a great time. Like some of the insights you're giving here are unique and I'm really enjoying this. But to close this out, what would you say is an investing experience that impacted you the most in your career?
Jeez.
Come on, man. You're a young man. There's not that many. Come on. I'm messing with you.
Yeah, I know. It's like, dude, like what we just lived through was like dog years, right?
Yeah, that's true.
I mean, we just economically, right? Like, geez, it's really, and also being contrarian, you're playing a different game. It's like
100%,
right? Like, and I'm contrarian. Like, I'm really contrarian, like every stock, and I have a concentrated portfolio. So it's intense. It's really intense. And you have to be right. And if you're not right, you will lose, and it'll be a problem. And so I have career risk, right? If I'm not right, I'm losing money, no investors, it's over. Like, that's a pretty big deal, right? So I think that it makes you very, 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 careful. So, but I'm going to go forth confidently, right? Because you have to. You live once. This is what I love. Let's go. And there have been so many experiences, and I want to make sure I give the best one. I could say March of 2020, right? That was an interesting time. Man, that's a good question. Usually I know what I want to answer before the person even, finishes. What was the most impactful experience you
Yes.
Jeez. I'll say the market crash.
Yeah.
I'll say that because that really took the approach from micro to macro. I had to have a macro lens. I knew eventually I would get there, but I just find that I'm put in these situations where you kind of have to get there now, right? And how do you go about it? Well, you reason your way through and you think about the substance of it. But I think it was the most impactful because it's one thing to go contrarian on individual stocks, and you have the data for these individual stocks, but when you're going like this macro contrarian and like the market is just hemorrhaging capitalization, right? I've got this sign in my office. It's from the market crash in 1929, and it's the Wall Street Journal. I'm sure you've seen it. The words really matter, the order. Market, investors panic as market crashes, right? Whereas I have that up in my office because I don't see it that way. And I learned this. I actually see it as market crashes because investors panic. Like investors make the market. Like the market isn't separate from the investors. You all set the price. The market sets the price in the market, right? So that just teaches me basically that it's the people that are it's a self-fulfilling prophecy. So I would say that this, it just showed me that what I was doing on a micro level based on substance and logic. Let's just say this: the opponents that I met at the track meets on a micro level, I found that they're the same people that I met on a macro level. I actually think it's a little easier. I'm going to stay micro because I love micro. I love, individual companies, but I would say that's the most, that's the most significant experience is to it took the confidence level and it actually helped create what I call my investment philosophy. Up to that point, I had investment strategy, but now I have an investment philosophy. And it's based on this, concept that I call desire to participate. And on my site, I actually have something that, some people love it, some people don't understand it, but I wanted to publish it. I have a diagram. I call it the pragmatic market pricing theory. And this is how I believe that question of, hey, these stocks are moving. Why? What's the reason? It's a part of that. That is the visual depiction of how I believe the market actually works, aside from a lot of the terminology that people use and kind of like going to the market with their preconceived notions and trying to force it upon the market, but you're not getting the intended results instead of looking at the market and accepting it for what it is. And so that came from the market crash and just studying it the same way that I studied individual stocks. So, while I definitely would not want to relive COVID or anything like that, that experience changed my life personally as an investor, and it helped me see I have a full investment system. So yeah, that's it. I couldn't say anything else, honestly. I mean, look, right?
At the end of the day, look, you branded yourself as the contrarian investor in March 2019 on a podcast. Here you go. Are you? Put your money where your mouth is, dude. Right. All right. And you did. Right. And you came up with a whole system around it. I commend you. You're like, all right, this is what I believe in. Here we go. Let's do it. And it worked out a lot.
Yeah.
Really a lot.
Yeah. It worked out well. I'm really thankful, and the data was there. That's the most important thing, is that the data was there, and I stayed true to the principles, to those contrarian principles, right? And then and just found a way to adapt it. And that's how you know something, or you have an understanding of something, if you can solve problems that the professor never actually asked in class and wasn't on the study guide, but the structure of the problem is almost identical. So that was a phenomenal experience, and it helps to be hedged. It definitely I paid considerable hedging cost to keep net exposure, really low, to create this asymmetric risk reward. So that was also a good time to be hedged. So.
Very good. All right. Well, to close us out today, Mark, for new investors, just any investors in general, what advice do you have for them?
Think unconventionally. Our tagline is unconventional thinking, unconventional results. And I really, 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 really believe that. I believe that many investors would do so much better if they just thought about this as a logical problem and came to their own conclusions about how to think about something, instead of having an operating manual where it's like kind of step by step, right? This kind of heuristic based approach. I would say just think unconventionally, think about the logic of what you're doing and what is happening. And I think that'll make you trust your conclusions much more and fear the market less. I think a lot of investors fear the market because it's this woolly mammoth that can crush you. But I think that'll give you the confidence to go to battle with this woolly mammoth and win, because you thought about it the right way, and the market doesn't really think. It's highly reactive. And so, I would just say take time to think, and just don't take some operating manual. I'll say that. I will say one more thing, and I may get in trouble from the value investing community, but I do have to kind of say this. I strongly question. I would tell them to strongly question the notion that anything denoted in monetary value has intrinsic value. Money itself does not have intrinsic value. It has ascribed value. We ascribe that value. That's where the price comes from. And I believe that only life itself has intrinsic value. So everything else has a price, and it's driven by certain things. So I would just say, just think about, what does that truly mean? What does intrinsic value truly mean? Because if you're spending all of your time and energy trying to calculate intrinsic value of a stock, which is denominated in dollars, of a company which makes dollars, and these dollars themselves don't have intrinsic value, you may be better served spending more time thinking about, well, what is the market? What do people actually make decisions on? Because what are the chances that people kind of converge upon this shared intrinsic value number? I can create it. I can do a DCF and make one, but I'm not rewarded based on what I think the fair price is. I'm rewarded based on what the market thinks the fair price is in the future. And so I don't think it's about fair price. I just think it's price. And I say that because I love business. And what I found is that the market is not purely about business. And I know that because this is in the research business that I had. I found that, and even in the networking, I found a lot of market participants don't do real deep microeconomic research. So I think it's more about stocks and ticker symbols, and kind of talking about a company, but not truly understanding the essence of that company like an insider would. So I do think that there's a separation between the stock and the business, and the business affects the stock, but the stock has an auction effect that makes it take on a life of its own. So I know that's a lot, and this is what I tell my interns. Yeah,
but you have to close out. You have to close out with that, man. Like, come on, we already covered so much good stuff. You're going to start with me with that. I had all this coffee. I'm like 10, 12 questions. Like, you're killing me right now, dude.
I'm getting a lot of hate mail about this intrinsic value statement, man. I'm getting a lot of hate mail, but, you know, I believe that people should think about that and think, does that really make sense to even think about? Because value itself is a subjective term. Mm-hmm. It just is, right? So I think that people would be better guided if they just thought about what are the drivers of this. People can want to short Tesla all they want and say this and say that, or talk about the Fed and how they're just printing money. But at the end of the day, this is how things work in this advanced economy. It's all about expectation. And as long as a company can continue to get people to believe that the future is bright, then people are going to behave a certain way. And you can stand on the outside and complain that this is wrong, but I would rather write letters to my investors explaining how well they're doing than writing letters to my investors explaining that the market is broken and this is why, we're not really doing well. Your purpose as an investor is to maximize returns. This isn't a religion. So yeah. Anyway,
right. I hate to stop there because we're now going down so many rabbit holes on behavioral investing, intrinsic value, what does value investing even really mean anymore? And so I'm going to stop it there because you're going to come back and we're going to talk through all of this stuff again. Yeah. So Mark, with that, where can my audience go and find more information about you? And, this is going to come out in like about 2 weeks. So in the event that you were to create a Twitter account in 2 weeks, I can't say because then somebody will steal it. But where can people go find more information about you right now?
Yeah, so the main place, to follow, Pragmatic Capital as far as what we're doing would just be the website pragmaticcap.com. And we've got a distribution list on there that you can subscribe to follow our performance. I have monthly letters and quarterly performance reports that are really informative, not just about performance, but more about why the performance was what it was. That's the most important thing because it's about having your investment system. So yeah, you can just find me on there. I'm also on LinkedIn. If you're on SumZero, I'm on SumZero. And I'll seriously consider the Twitter. I think that, after this conversation is showing me, maybe I do have some additional views, more even philosophical, that I can talk about on Twitter to kind of get some conversations started.
Not just that, but even feedback too, right?
Yeah.
We all live in our little bubbles, but it's nice to be like, oh, maybe I should adjust how I think about it.
Yeah.
But
as long as everyone has the data, we can have great conversations.
And it's respectful. But number one.
Yes.
But with that, Mark, thank you so much for joining me today, man. This was unbelievable. I really enjoyed our conversation. You're coming back. So till next time.
Yes, till next time, man. Thank you so much.
Thank you.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.